Hello students, I am Dr. Rashmi Chawla and today we'll be discussing mainly about tax audit. Besides shareholders, the audited financial statements have different users like creditors, potential investors, lenders, tax authorities, etc. The information revealed by the financial statements may not be as per the specific requirements of these users. Tax authorities need this information to charge taxes and allow deductions. It is in this context that concept of tax audit developed. So, tax audit, as the name suggests, is what it is an examination or review of accounts of any business or profession carried out by taxpayers from an income tax viewpoint. Makes the process of income computation for filing of returns of income easier. It is also defined as an examination of financial records to assess the correctness of calculation of taxable profit, to ensure compliance with provisions of the Income Tax Act, and also ensure fulfillment of conditions for claiming deductions under the Income Tax Act. So basically, it is prepared from the income tax point of view and it is just an examination and review of accounts of any profession which is carried on by taxpayers. Now we come to the objectives of tax audit. Now, tax audit is conducted to achieve various objectives. First one, it ensures proper maintenance and correctness of books of accounts and certification of the same by a tax auditor. An analysis of the accuracy of income tax returns filed in an assessment year by individuals and companies and maintenance of records by chartered accountant. All this is done by the tax audit. Second, reporting observations, discrepancies noted by tax auditor after an examination of the books of accounts. It checks frauds, malpractices in filing income tax returns. Reporting of findings by the tax auditor after a detailed analysis of accuracies or inaccuracies in tax returns filed are also done by tax audit. Third, to report prescribed information such as tax depreciation, compliance of various provisions of income tax law, reporting essential details regarding compliance, tax depreciation, etc. as per the laws of income tax. All this comes under the objective of tax audit. This streamlines the processes for the income tax authorities in calculation and assessing the accuracy of the income tax return filed by the individual or company. All these enable tax authorities in verifying the correctness of income tax returns filed by the taxpayer, calculation and verification of total income, claim for deductions, etc. also becomes easier. Now, we come to the topic, who is mandatorily subject to tax audit? So section 44AB generally describes the persons for whom the tax audit is compulsory. So a taxpayer is required to have a tax audit carried out if the sales, turnover or gross receipts of a business exceed rupees 1 crore in the financial year. However, a taxpayer may be required to get their accounts audited in certain other circumstances, which we'll be discussing in the next slide. Now, there's a note over here. The threshold limit of rupees 1 crore for a tax audit is proposed to be increased to rupees 5 crore with effect from assessment year 21-22, that is financial year 2020-21, if the taxpayer's cash receipts are limited to 5% of the gross receipts or turnover, and if the taxpayer's cash payments are limited to 5% of the aggregate payments. Now, we already discussed about who's mandatorily subject to tax audit. we have discussed any business or profession where the gross turnover exceeds 1 crore in the financial year. But there are certain other circumstances which we'll be discussing over here. We have made two categories. One is business, other is profession. So before discussing this, we should understand what is presumptive taxation scheme. The presumptive taxation scheme was introduced by the Income Tax Act as a means through which small taxpayers who perform tasks such as the auditing of accounts as well as maintaining account ledgers would receive some form of relief. This means that any individual looking to avail of the scheme will be able to declare his or her taxable income at a predefined rate while obtaining relief from the cumbersome task of account maintenance and audit. For this purpose, the Income Tax Act has introduced presumptive taxation schemes under Section 44AD, 44AE, 44BB, 44BBB. The first one, we see that tax audit is compulsory for a business owner who has not opted for presumptive taxation scheme with gross receipts or turnover or total sales exceeding rupees 1 crore. Then, a business owner who has opted for presumptive taxation scheme under Section 44 AD of the Income Tax Act 1961 with gross receipts or turnover or total sales exceeding rupees 2 crore. A taxpayer whose business which is eligible for presumptive taxation under Section 44 AE, 44 BB and 44 BBB claims profits that are lesser than the prescribed limit under respective presumptive taxation scheme. A business owner who is not to be eligible to claim presumptive taxation under Section 44 AD because he or she has opted for it in a certain assessment year and not for any of the 5 consecutive years subsequently. This is applicable when his or her annual income is more than the maximum amount not chargeable to tax in the following 5 consecutive assessment years from the taxpayer. Then we come to profession. Any employee of an organization profession whose gross receipts is more than rupees 50 lakhs in the financial year. An employee or professional of an organization that is eligible for presumptive taxation under Section 44 ADA and claims profits that are lesser than the prescribed limit under presumptive taxation scheme and income is more than the maximum amount not chargeable to tax. Now, what happens if a person is required to get his accounts audited under any other law? For example, statutory audit of the companies under company law provisions. That means if he is not getting his accounts audited under Income Tax Act, then he is getting audited under any other company law provisions. So what is the answer? In such cases, the taxpayer need not get his accounts audited again for income tax purposes. That means if you are coming under any company law provisions, then there is no need for the taxpayer to get his accounts audited again for income tax purposes. Sufficient if accounts are audited under such other law before the due date of filing of the return. The taxpayer can furnish this prescribed audit report under income tax law. Now, who constitutes the income tax report? Who constitutes audit report? Tax auditor shall furnish his report in a prescribed form, which could be either Form 3CA or Form 3CB. A Form 3CA is furnished when a person carrying on business or profession is already mandated to get his accounts audited under any other law. Form 3CB is furnished when a person carrying on business or profession is not required to get his accounts audited under any other law. In case of either of the aforementioned audit reports, tax auditor must furnish the prescribed particulars in form number 3CD, which forms part of audit report. Now, what is the penalty for non-filing or delay in filing tax audit report? Now, If any taxpayer is required to get the tax audit done but fails to do so, the leads to the following will be levied as a penalty. Now, if any person makes a default in filing or delaying in filing tax audit report, the penalty may be leads to the following. It is 0.5% of the total sales turnover or gross receipts, or rupees 1,50,000, whichever is less. Now, how and when tax audit report shall be furnished? Now, let us go through this. The tax auditor shall furnish tax audit report online by using his login details in the capacity of chartered accountant. Pay attention, it is chartered accountant. Taxpayer shall also add CA details in their login portal. Once the tax auditor uploads the audit report, same should either be accepted or rejected by the taxpayer in the login portal. If rejected for any reason, all the procedures need to be followed again till the audit report is accepted by the taxpayer. Now, audit tax report must be filed on or before the due date of filing the return of income. It is 30th November of the subsequent year in case of the taxpayer has entered into an international transaction, and 30th September of the subsequent year for other taxpayers. Now we come to qualification for appointment of a tax auditor. According to the provisions of Section 44AB, the tax audit report should be given by an accountant. Now, an accountant for the purpose of Section 44AB will mean a chartered accountant within the meaning of the Chartered Accountants Act 1949, and includes a person who is eligible to be appointed as an auditor of a limited company under Section 226 subsection 2. As per the provision to Section 44AB, in case of assessee, for example, a statutory, for example, a cooperative society or a Hindu undivided family, etc., whose accounts are allowed to be audited under any other law by a person other than the chartered accountant, the tax audit may also be conducted by the statutory auditor, who may not be a chartered accountant. Further, a chartered accountant in practice who renders tax consultancy on a professional fee basis, not as an employee, can also conduct tax audit. Last, who can be appointed? Appointment of a tax auditor, who can do it? And what is the ceiling on the number of audits? The tax auditor may be appointed by the management of entity or any other person duly authorized by it for making such appointment. Similarly, a partner of a firm, a proprietor, or any other authorized person can appoint a tax auditor in case of partnership firms or proprietary concerns. Now we come to the ceiling on the number of audits. A chartered accountant cannot accept more than 60 tax audit assignments in a financial year. In case of a firm of chartered accountants, the specified number of 60 tax audit assignments is to be counted for every partner of the firm. So the ceiling for the number of audits is how much? It is 60. That's all for today. Thank you so much.